What's going on, Dividend Chasers? It's the Dividend Bloodhound here with another investing video. This episode we're going to talk about a risk management strategy for your portfolio to keep your money safer. So in this episode we are going to talk about diversification. If you like what you see in this video, please hit the subscribe button below or give that like button a smash. Just get that out, a little plug now, and on with the video. So what is diversification? It is a risk management strategy for your investments as a whole, but more importantly, in my opinion, your stock market portfolio. So, in order to not lose all your money, if one thing happens to one company, it is best to spread your money over a multitude of different companies and different sectors. So, not just putting all your eggs in one basket, so to speak, and investing in just one company and then something happening and all of a sudden the share price goes through the floor, your dividends are out the window, and all of a sudden you've lost loads of money, which is what a lot of people think of when they think investing, which is something that, in my opinion, has to change. We've got to get more people investing, and I think that's good for everybody. So, as I was saying, the best risk management strategy is to spread your money throughout a few different stocks. Now this means that you won't get an absolute world-breaking dividend each time, because you're going to spread your money a little bit thinner and have a dividend potentially each quarter, as mentioned in a previous video, getting one each month. So you spread your money a little bit thinner and get more dividends more often, but with less in them, obviously, because you've spread your money out. So if you were to split it, your £1,000 down, you could split it into halves, you could split it into quarters, or you could split it out even further than that. But your key point is to spread the money out. And especially not just into companies in the same sector. So it's probably no good investing in, I don't know, let's just use Boeing for example. It's no good investing your £1,000, £500 into Boeing and £500 into Airbus. Because okay, at the moment Boeing's having its issues and Airbus isn't, which would slightly diversify your risk, because your Boeing part will be down but Airbus will be slightly up. But if something hits that industry as a whole, for whatever reason, whatever it is, it really doesn't matter. Maybe there's an uptick in, I don't know, bird strikes hitting planes all over the world and all planes are grounded. Guess what's going to happen to that sector? Unlikely, I know that it is, but guess what's going to happen? The share price is going to go through the floor, because them companies aren't going to earn much money anymore. So the idea is you want to split your money between maybe an industrial stock, so something like Boeing or Caterpillar or Airbus, something like that, and then go for a pharmaceutical company. So you get your, people are always going to need drugs, vaccinations, coronavirus is around at the moment. All of them things, people are always going to need healthcare. Then you go for food items. So you get into a food sector, Starbucks, Coca-Cola, Pepsi, anything along them lines. And then next you go for perhaps consumer goods. So you've got some like washing up liquid, dishwasher tablets, floor cleaner, sponges, mops, things that people can't do without. And then you could go into the tech market. So you've got Facebook, you've got Google, Amazon, Tesla to an extent, IBM, all of them are in the techie world. And then, so over that brief little list that I've thought of, literally off the top of my head there, just by knowing some stocks, you've split your money across all the sectors. So it's unlikely that something will hit all of them sectors particularly hard all at the same time. It really does. I mean, I know coronavirus is in the news at the moment and the stocks across the world have taken a bit of a wallop. But that's everybody taking a hit. It doesn't matter where you put your money at that point. Everybody's going to take the hit on that one, and that is just part of investing. You can't really do a lot about that. What it is a good time to buy. So when the value goes back up in a few months' time, when this crisis passes, guess what? You've made extra in that meantime. one thing I would say is, yes, diversification is a risk management strategy, but you cannot eliminate all the risk from investing. It's impossible. You just can't. You can't foresee what people would say is acts of God or things like the coronavirus or anything like that. You can't completely eliminate risk from investing. That's what comes with the reward of it, is there is a potential to lose out as well. Now, with this strategy, you can mitigate that to the nth degree, shall we say. You can eliminate most of that risk, just never all of it. So what are most property professionals out there, I'm not a professional, this is just my opinion, and this is just my own research I've found on the investing on my mind, through reading books or searching on the internet. This is what I've found to be the most common sort of thing. So a portfolio of 20 to 30 stocks eliminates 80% of the risk from your portfolio. So then 20 to 30 stocks split evenly over the sectors that are in the stock market. You don't have to go mental and have a little bit in each and every tiny little sector, or split your companies up here and there. It is okay to have a couple of companies in the financial sector, in the health sector, in the industrial sector, as long as you are split evenly enough so as to not bias your portfolio and massively lose out if a sector fails. Now, you can over-diversify. I can't stress this enough. My research also suggested that if you bought over 100 stocks, there's something out there called essentially diversification. So yeah, you're so diverse that you are very unlikely to miss out or lose a great deal. You are very unlikely to lose out on your money or get hit in the pocket in any way, because you'll literally spread yourself really thin. But at the same time, you've reduced all your benefit as well, because you won't. If one stock did increase massively for whatever reason, you're only going to get that much out of it. You're only going to get a tiny bit because you've only got a tiny bit in there, if you understand what I mean. So you spread yourself so thin, you don't actually gain to make much benefit from anything really. So if that's how you were going to be, I would suggest investing in an ETF. So just plucking one out of the air, the S&P 500, put your money into that, and then let the professional at the other end spread the money across the whole of the US economy, and you just gain the dividend payment that you get every quarterly, and all of it's just taken off your hands, and it's somebody else's problem, so to speak. And it is relatively safe, and it brings steady returns. Not going to make you rich overnight, but consistency, reinvesting, you will get there eventually, because I think averagely over the last 20 years or so, the S&P 500 has returned about 10%. Between 5 and 10% is about right. Now, in some other research, that suggested that if you kept that up, if you invested $200 a month, or $200 a week, should I say, over 20 years, you could, through the effect of consistency, compounding and reinvesting, you could be a millionaire within 20 years, just through that alone, regardless of whether you added more or less. If you added more, obviously you'd get to be a millionaire even quicker and have more money out of it. Anyway, I digress a little bit. So, not only can you diversify through your portfolio, as we've already discussed, you can also go across your asset classes as well. So not just in the stock market, you can invest in property, stocks, bonds, crypto and commodities. So you've got your traditional stocks on the market, like, as I've already mentioned, Boeing, IBM, AT&T and the like, Coca-Cola. And then you've got bonds, which are a slightly safer form of investing, because they're usually bankrolled. So you'll get less of a return, but they're usually bankrolled by the US Treasury, the UK government, UK Treasury, them sorts of things. Institutions that aren't likely to go bust anytime soon. so your money is reasonably safe, but you get a bit less of a return against it. Property, you can go into bricks and mortar, much like I have myself. I've got my stock market portfolio for dividends. In fact, I've got 2 of them with free trade and trading 2-on-2. Just while I'm talking about this, I do have a free share referral to give away for free trade, where we can essentially get a share worth up to £200 each. If you're interested in this, please comment in the sections below, and I will get you a referral link if you want to set yourself up an account, and we could both get a share worth up to £200. And that's the same with trading 2-on-2. If you've been on my channel before, I have a referral link for that one where we can both get a share worth up to £100. If you're interested in this, please comment in the box below, hit me up on Instagram, or find a way to contact me, and we will both benefit massively. Now, what was I saying? Right, back to property. Yeah, I invest in property. So I've got my dividend portfolio, free trade, and trading 2-on-2. I've got a growth portfolio with Moneybox, which is a slightly higher risk global ETF that I've put some money in over time. And then I've also got my small property portfolio. So I've got 2 buy-to-let properties that returns me about £1,400 every month into my pocket for tenants living in my other flats, essentially. And it provides a passive income that I don't really have to do much towards. It pays my mortgage, there's some left over in my pocket, and I get the appreciation value of the property going up over time. So therefore, I'm split over 2 asset classes here. Now, things that I don't really understand, and I'm not going to pretend to understand, is cryptocurrency. So this is not my area of expertise at all. So if you want more information about that, please go to other YouTubers, which I'm sure are out there to help you out. All I know is that there is potentially a lot of money to be made, but also there is some hefty risk involved with that as well, and it can go flying up and it can come flying down, and you'll be left potentially in the middle. I'm not going to try and put you off, it's just not something that I do personally, but each to their own. If you wanted to diversify across into that and bonds, that's completely on you. And then last but not least is commodities at the end. I've missed the way off because I ran out of board, unfortunately. So commodities are things like your oil, gas, gold, silver, metals, precious metals, all that sort of thing. You can buy and you can trade in them as well. Again, not my area of expertise or research, so I'd again tell you to go and do your own research into that sort of thing. But there is money to be made. You can certainly buy low and sell high, as Warren Buffett says. If that, don't quote me on that. That might not be him. But yeah, buying low, sell out high, but you just have to keep a watch on it. So you can invest in all of these, or just stock and diversify your portfolio, or do stocks and property like I do. That's my area of expertise. So halfway down the middle. Stock, growth stock and dividend stock that side, property portfolio that side, and that in itself is diversified because I've got 2 properties in 2 different areas, so I've split the risk on that one as well. Excuse me. So that about wraps things up for this video. Just wanted to get some of the lingo out there for you guys to see and hear and get to grips with, and I will catch you again in the next video. See you soon.